Hey everyone, welcome in to another daily editorial here on the KE Report. We're chatting with Joel Elconin, and we're going to be focusing on the market's continued pullback with the S&P down over 4% this week. That is on a shortened trading week too. The NASDAQ down over 5.5%, and it seems to be stretching to almost every sector out there. Look, there's just a lot of red on the screen. Joel is the co-host of the Benzinga Pre-Market Prep Show, also editor of the Pre-Market Prep website, which we will link to in the show notes. Joel, market continues to correct. Doesn't seem like this is the immediate buy the dip opportunity that investors seem to have jumped in during some past short and shallow corrections. Albeit, hey, we're 4 days through this shortened trading week, and it's been tough all week. What's your takeaway from this action?
Good afternoon, gentlemen. Thanks for having me. I wish I could give you some better news on the market. We discussed last week and over the last couple of weeks that they took the market back up to all-time highs, and just very much all-time highs in a short period of time. And you just ran out of buyers. I mean, it's a simple fact, buyer exhaustion. And then you got to the levels of the S&Ps, if coming up into the end of the month. Lock your bonus in, that monthly bonus, not a quarterly bonus. And then you just tech earnings, Nvidia, the whole world was long. Nvidia 150 calls. Nvidia disappoints. People hold on to those positions. They don't cut bait. And you have other factors working. And the main factor, which people don't like to talk about all the time, is valuations. And valuations are stretched across the board, especially in the AI sector, and it doesn't attract value investors, especially when you're in an environment where there is an alternative, there is a Tina on the block. So there's competitions for funds and savvy investors. I think I stressed this last week too. It was easier to identify resistance, right? It was very clear. The market gave you a lot of warning signals, and then they just overran the buyers. There's a difference to selling into strength, like our buddy Warren Buffett, who's been unloading Bank America hand over fist, selling into strength. He sticks it in the teeth of Wall Street at 40. He goes up to 41. He has more to go there. So it's just a seller's market right now, and the bulls are on their heels.
Well, Joel, I thought everybody was excited about the sell in May, come back after Labor Day. Traders were going to be at their desks, and then they came in and hit the sell button. But to your point about Warren, if you look at what Berkshire Hathaway has done, it's kind of seen as more of a safe haven stock, kind of a value stock. But he also was selling Apple, and that made the rounds. And he also was buying Ulta Beauty, but he's been a lot more active, or I guess his team has been a lot more active. What do you make of the action in Berkshire Hathaway?
I mean, Warren's been conservative. He's getting up there in years. I think the most notable thing about Warren's action is that he's just not, besides the Alta, which was a beaten down stock, it looks like he made a good purchase. It got the Warren pop after the release of the 13F. They got hit off earnings, but Warren was out there looking. But I think what investors are looking at is Occidental Petroleum here. Now, you guys probably don't have the long history of Warren and Oxy, but he's been buying this thing for a long time. He started buying it to help finance the Anadarko Petroleum buy. This was back in late 18, early 19. He bought at extremely high prices. He missed the bottom in COVID. He started buying back up, but Warren had basically been single-handedly supporting that stock at the 55 to 57 area since early 2022. Well, you'll see if you look at your daily charts, Warren had enough of that and it lost its bid. And now, along with the price of oil declining, you have Occidental Petroleum here trading at its lowest level since April of 22. How Berkshire made a new all-time high this week on just a massive win streak, perhaps on a flight to safety, is beyond me. It hit a stunning reversal, made an all-time high on Wednesday. A really bad day on Thursday, and just continuing with the market here. So, yes, it's a proxy for the safety trade, right? A lot of cash as insurance stocks are doing well. But when the VIX gets elevated, the market gets going in one direction, the stock is a stock. and they hit it. And that's what that pressure. But his Apple's held up well. He sell a small portion of that, trying to sell into strength in Bank America is very revealing to the market.
Yeah, to your point about the VIX, even through August and now starting off September, it's holding at generally higher levels than we have seen for quite some time. But the whole concept here of where there might be opportunity, look at what happened to even the 10-year note today. It dropped the whole way down to 3.65%. That's the lowest really since I believe about April of last year. Is there any opportunity in these interest rate sensitive stocks and sectors?
Well, it depends. I mean, you could look at the bonds and the TLT and look at these things. Utilities, I mean, you asked me a couple of weeks ago what was showing some relative strength, what was holding up, and there was the utilities. So you have the mantra, the rates are going lower, so your interest sensitive stocks are reflecting that strength. But if you go into any kind of a recession, who cares how much rates are coming down? People are not going to be going to the bank and getting loans. People are not going to be as anxious to do things. The banks overall have held up pretty well. The utilities, just that tenor of lower interest rates. And you've also got some capital appreciation too. So that's the story here. And utilities, well, they did make an all time high. I'm looking at the XLU here in mid 22. But yeah, I'd be more prone to probably go to the utilities than the banks. That at this point, I mean, individual banks, they're all can't lump them all together. But I think one thing that we talked about a couple weeks ago, and then the narrative changes, and then what makes you a little cautious on the banks here overall is the yen carry trade, right? The yen, I don't know if you guys have looked at the Japanese yen lately. I like to look at the futures because they tell the future. It had a spike to 71. That's when the market got absolutely annihilated. You had a really peaceful retreat to the $67 area, but don't look too far. That yen is back up again today and almost back at 71, the futures, which was the high of the move. So I think that you kind of could sweep it under the table for a little bit, but that rising yen, that yen carry trade may not be completely unwound. And what you're seeing today is that correlation that we talked about before with the yen. People short the yen to buy the tech stocks. Well, they're caught. They have to cover that yen and sell those tech stocks. So that correlation hasn't been as apparent, but is today. It's another concern for the market. It's being reflected in the prices of your overvalued tech and the rally in the Japanese yen.
Yeah, solid point, Joel. There's definitely a consideration that as that yen appreciates again, that they have to unwind their U.S.-based assets, and so that hits the tech sector. There's the valuation aspect, but these markets are dynamic. There's a lot of things going into it. What about seasonality? Typically, September is a crap month in the markets. It has been for a long time. Are there people that are just trying to get in front of the seasonality trade and get out of the way and then maybe buy back in at lower levels?
Well, I mean, it was pretty well telegraphed, right? September is a rough month. Now, what's interesting is it's usually the back half of September that shows the weakness, right? So this is a little bit, I mean, if you want to be a contrarian, which is so easy to do, but good way to lose money, this is a little bit buying opportunity. Maybe we catch a bid going into the quad wedge expiration. And then we know that those often can be turning points in the market. The other seasonality factor that I talk about, and I mentioned with you guys, but not a lot of people talk about, is Sel Rosh Hashanah by Yom Kippur. That holiday is coming late this year due to the Jewish calendar. So, yeah, the seasonality pattern of September is coming to play. Where the market was situated to all-time highs, the indecision about a quarter and a half. But what the reason I think the market is a little disappointed today is I don't think they're going to go a half. I think that they're going to go a quarter. I don't think they're going to do anything in November because I believe that's like 2 days after the election, and we don't even know if we'll have a winner or not. Who knows if we'll ever have a winner announced. So they're really trying to push the hand of the Fed. Today's data was not enough to like totally validate, yeah, we got to go a half. So the market gets ahead of itself with Fed's expectations. And even though inflation's coming down and unemployment's steady, it's hard just to make a solid case that you cut a half, you cut a half, you cut a half. And here we are back opening up the spigot and pouring money, easy money into the markets. We all know how that can end.
No, we do not. But boy, oh boy, the markets are, I think, starting to ask for a little bit more of an easy money policy. We'll see if it makes a difference. Overall, though, then, Joel, how worried do we have to be about this market? Look, I realize dips have been bought, but when do you get the feeling? When does it tell you that that market sentiment has totally changed for a longer term period?
I mean, just based on my technicals, there's nothing there I can give you. And I don't want to say we're going all the way back down to the August low, but the market has to find an intermediate level above that. Now, what the problem is going to be is there's not a lot of catalysts coming up, right? We're through the majority of earnings season. You do have some inflation numbers, which I expect to come down. I don't think Wall Street analysts right now are not exactly primed to be pounding the table on the market. So, I mean, I could give you those lows back from August, but we traded down there so briefly that I don't know. No, we got to find an intermediate support level ahead of that. And with my methods of technical analysis, I mean, if you're taking a stab here at the S&Ps at 54.22, you got to be cut it out if they make the low of the day and reset. So not seeing anything in the short term here, maybe getting a little bit oversold in some things. But as we all know, oversold items, oversold trading instruments can stay oversold for a long time. And a lot of people have lost their shirt shorting overbought instruments too. So your RSIs, your stochastics, those indicators, well, they can stay at those elevated levels for a long time before they make a turn.
Yeah, very good point there, Joel. It just seems like this market sentiment has very much changed. Now, this stuff can change very regularly and very quickly, but I don't know. To me, I think I'm with you here where the Bears, they seem to be in control, and this could be maybe early on in terms of a correction throughout the rest of this year, at least maybe into the election. But hey, something that gives us a lot to talk about over the next few weeks and few months. Again, Joel is the co-host of the Benzinga Pre-Market Prep Show, also editor of the Pre-Market Prep website, which we will link to in the show notes. Joel, thanks for your time. Have a great weekend.
Okay, thank you guys.